All right, let's get this show on the road. Hi, guys. Good morning. Thank you so much for joining me, Dino Omar, and welcome to our workshop today. Today, the workshop is titled Robo Advisors Helping You to Invest Your Spare Change. So, on behalf of my team here at LINC at Astro AWANI, we want to say thank you for being part of this workshop. We hope that you're going to be going away with knowledge that you'll be able to use immediately. So at the end of the session, I hope you have a clearer picture of where you can be parking your money, especially if you are thinking, oh yeah, I want to invest, but then I don't know where to invest. Or if I want to invest in stocks, it's a little bit too expensive. Well, that is exactly why we're having this session today. Because robo-advisors, whilst it's not new in the market, it's been around for about a decade or so, but in Malaysia, it's relatively new. And the attractive thing, at least for me and my team, is that robo-advisors allows you the opportunity to invest with a low entry cost. You are the boss of your own investment because you get to do everything yourself using your own devices, and you get to choose the risk profile that you will be comfortable with. So these are some of the attractive facets of robo-advisory, but we want to understand a little bit more about the market and also why you should be investing, what are millennials doing, and what is the current trend in investing. So before I go any further, please allow me to share with you a couple of hygiene points. First of all, we recommend that you shut down your video and audio tabs to clear up your bandwidth for a better experience. Should you experience any technical difficulties, you may exit the room and use the same link provided to rejoin at any time. So please do not panic. We may be running polls during the session, and I will be running a poll right after this. So please feel free to participate via the tabs on your screen. We want to hear from you. Also, if there is a major glitch that is experienced by a majority of the people in the room, so this is something that we will realize that, for example, the number of attendees drop. In case there is a major glitch, we may reset the entire system. So all you need to do is just to sit back and relax, and you'll be taken to a new room automatically. And we thank you for your patience. And last but not least, we have a moderator standing by to answer all of your queries in the chat room. So if you have a question you would like to ask the speakers, or if you have a point of view that you'd like to share, kindly mark your remark as a question if it is a question, and we may flash it up during the Q&A session at the very end of this webinar. So we want to hear from you. Please keep it interactive. Give us your thoughts. Share with us your questions. If you have anything that you want to know, do share with us in the chat room. My colleague Hani is going to be in the chat room, and she is going to be talking to you. If you have any technical questions as well, you may do so and post it in the chat room, and we'll be able to address it as best as possible. So now, please allow me to introduce our speakers for today. So gentlemen, I'd like to invite you to please turn on your cameras so we can see your face, and then I will introduce you. There we go. We've got our champions in the house right now. Thank you so much for joining us, gang. Okay, so we have with us Mr. Wong Wai Ken, who is the country manager of Stashaway Malaysia. Ken, very good morning to you, and thank you for joining us.
Morning, Dino. Hello, everyone.
Yes. And we also have Mr. Vincent Fong, who is the Chief Editor and Country Manager of FinTech News Malaysia. Vincent, great to have you on board.
Thank you for having me. Glad to be here.
All right. So we want to talk about robo-advisors. But before we do that, how about we throw out some definitions on what robo-advisory is? Because if you Google on the internet, the concept is very, very simple. It is an algorithm-based investment platform that basically exists on your mobile phone. Is it really as simple as that? Perhaps, Ken, you want to take this one?
Yeah, sure. Thanks, Dino, for introducing me and bringing me on the show. So like you mentioned, it's really important to understand what robo-advisors are. And more importantly, is it really that suitable for you, right? It's not about technology. It's how it adds value to your life. So like you mentioned, one of the key unique selling points is the fact that you can invest with very low amounts or very low fees. So I think that's part of the appeal, but really you should also ask yourself, does it really suit your risk preference? Does it bring you to your financial goals? What are you really investing in? So there's really two parts to robo-advisors. The first part is how you access investing, right? So like you said, you go download on your phone, you go on the website, and then you set up an account, and then you choose the portfolio. That's the first part. The second part is, what is the actual portfolio? Because no matter how you invest, you must know what you're investing in. So when investing with Stashaway in particular, what you're investing in is across different asset classes or all around the world. So by different asset class, I mean stock, bonds, gold, real estate, all together in a diversified way. And the second thing is that it's global. It's not just in Malaysia, it's in the US, it's Asia, Europe, and all that. So yeah, first thing, it's all about personalization, how you access it. Secondly, what are you actually investing in?
Okay, so when we're talking about, what are you investing in, we also want to know at the moment, if we're talking about investing in general, who are the people that's actually investing to begin with? Maybe not just in robo advisors, but investing in general. Is it a concept that is accepted by everybody? Because we ran a poll recently. Now, before we go any further, can I just check if you're listening, you're hearing me okay? Because
Perfectly, no worries.
yeah, a little bit of feedback on my system. It's all right. Okay, so we ran a poll of a couple of days ago asking people what are they doing with their money. And as I have shared with you two gents before, out of everybody that has responded, about 2/5 of them have said that they are saving their money in a savings account because it is safe and they know that the money is going to be there and it is protected. It's in the bank. It's not under the pillow at home now. 2/5 are saying they are investing. What they are investing in, a multitude of choices, a multitude of asset classes. And then there's a fifth that actually said they don't know how to invest. They'd like to invest, they do not know how to invest. Or also some have said that they actually don't have enough spare cash to be investing. Right? So we need to understand who is actually investing in the various asset classes right now. So can I invite Amy, my colleague, to run the poll? We're actually going to be running a similar poll right now. So attendees, if you click on the poll button on your screen, we'd like to hear from you. We will come back to the answers a little bit later on. But for now, I want to understand who are the people that are investing right now. Is it the older people that invest? Is it the younger people that are also investing? Vincent, this one is for you.
Okay. I think primarily one of the issues is that Malaysia, as a nation, our population is underinvesting. So recent kind of survey or study that was done by EPF indicated that 41% of Malaysians are relying on their EPF for their retirement without really investing into other things. So that is quite worrying because the same study actually indicated that 68% of them aren't even achieving the minimum 240,000 that's recommended by EPF. So ultimately, when we invest, we look at a few things, right? We want to be able to retire. We want to be able to maybe save for our children's college funds. So like you said, right, I think one of the barriers when it comes to investments is that, number one, people have this impression that investing is very expensive. And number two, people have this kind of fear, this kind of knowledge barrier about like investments being really, really difficult. So I think that's one of the good things about robo-advisors being introduced to the market, right? So robo-advisors was first announced by the then chairman of the Securities Commission Malaysia in 2017. And the first robo-advisor really to be introduced to the market is actually Ken's company, Stashaway, in 2018. So when you think about it, you look at our parents' generation, you look at our grandparents' generation, when they do invest, they rely a lot on their wealth managers, their remizers. But, a lot of us millennials right now are reaching the age of 30 and beyond, right? That's when we are starting to be a little bit more comfortable. We've developed a little bit more of a career and a little bit more of a disposable income to start investing. So this is a generation that are digital natives and they are more familiar, more comfortable with digital platforms. They may not necessarily feel the value of having a independent person to talk to you, right? Like if a software or if an app can do this for me, they may not necessarily see the need to interact with another person. So, that's where companies like Ken's kind of come into play.
Right. Okay. So in other words, what we're saying is that, out of the population that are investing, we can see a clear differentiation in the types of investment mode they will be going into. So the older generation are more attuned to having brokers working with them, so wealth management. And the younger sets would prefer to work with technology.
But that's also changing as well, and you can see that by the fact that even the incumbent banks are starting to move towards robo-advisor, right? Even UOB Asset Management has recently kind of indicated that I don't know if they've already launched it, but they are in progress with their own robo-advisor as well. So that shows like a shifting trend that they are recognizing that is not just for the millennials, but also for the older generation, because who could argue with convenience? I'm sure if you ask Ken, his demographics will also have some variation in terms of the age demographics as well.
Well, let's ask Ken then. Ken, tell us, what about your demographics?
Yeah, for sure. I think Vincent gave a very good overview of the landscape in Malaysia and why there is a real need to invest. I think coming back to your original question, savings comes hand in hand with investing. And before you have enough savings, say 6 to 12 months of your salary, you really shouldn't be actually investing actively. You should be saving up for your emergency fund, for your safety net. But after you have that as well, you really should look into investing, because that's how you put your money to work. Not just you have to work, right? You put your spare modal, your principal at work so that you can gain wealth over time. Like you said, putting it under your pillow is definitely not the way to become wealthy. So I think it really depends on which demographics are looking to really build their wealth. And what we are shaped by trends, like our parents are really shaped by Asian financial crisis and how they love stocks and then really hated stocks. And they really fell in love with property, because there was a very good property market. It was swore by property, right? You can just go get a mortgage, get 3, 4, 5 properties, and like it's a sure way of making money. Now we have a property glut. There's an oversupply. Now people are like, oh, where should we invest, right? And before the how hot the rubber gloves got, people were really not that interested in the local stock market, because in the last 7 years, Malaysia's stock market was only up once, right, in 2017. So I think we are really, shaped by these trends. And when we look at our demographics, our core demographics is 30 to 35. So people like us, right? So I think when you reach 30, you have this light bulb in your head that goes like, oh, my salary just won't cut it. I need to save for my wedding. I need to save for my kids' education, for my retirement. And that's where they really look around to see what are their options, right? And when you look at traditional things like unit trusts, it tends to be very expensive. Sales charge is very expensive. And then when you look at things like investment link policies on their insurance, again, very expensive and doesn't serve the right purpose of investing. So robo-advisors is a very easy way to let experts handle your money, because essentially you're outsourcing it to experts. You don't always have to do everything yourself. So with us, you can just download an app, choose a portfolio, and off you go.
I want to go back to the first point that you made just now, where you spoke about you have to have a savings of 12 months. This is from your point of view. You have a saving of 12 months for your emergency fund. So this is your cold hard cash that's being stashed away in the bank, and then you start building your investment portfolio, right?
Yes.
Now, when we are choosing to invest, there's this thing called risk profile that you would attach to yourself.
Absolutely.
So why would I want to go through 12 months of saving, all right, to accumulate 12 months worth of savings, when I can go into an investment and choose a low risk account, a low risk profile, and that would basically mean it's almost like savings, but then with small gains.
Yeah. So there are things out there like money market funds and FDs where you can basically take close to zero risk to actually grow your money a little bit, right? So in this environment where interest rates are so low, FD rates are so low, it's a really hard place to put your money because the gains are not that high, right? It used to be 5% in the late 90s, and now it's only barely 2%, right? So you can grow it a little bit, but you can't necessarily gain as much wealth as you would like. So you don't necessarily want to risk the money, especially if you're talking about an emergency fund, right? Your car can break down, you could be out of a job anytime in this COVID period, health problems and all that. So you need this spare cash, and you shouldn't put it to risk that money. But Of course, there's different parts of your wallet as well. It's not just, I want to be safe for the rest of my life. The amount of people I talk to who only have FDs is astounding. They show me big numbers on their Maybank to you or their CIMB clicks and say, oh, all my money is in FD.
Despite the fact that the performance is super low.
Yeah, because they just don't know enough. There's the knowledge gap, like Vincent said, about investing, right? So it's about that education and then taking risk in a very structured way, in a very deliberate way, moderate and high risk for certain parts of your portfolio to then grow wealth in a very gradual way.
Well, I think it's a changing trend, right? Because increasingly, I'm coming across more and more people who are asking me about, robo advisors, how to get started, and a lot of these people are first-time investors, right? And that is, to me, is a really positive development. So you see, like I said earlier, the robo advisors was first introduced in 2017, and in 2019, the Securities Commission annual report indicated that combined, all the robo-advisors are handling 74 million AUM from over 20,000 accounts. So that is a shifting trend. And I'm sure in 2020, given the whole COVID-19 situation, a lot of wealth, digital wealth tools, I'm seeing a huge uptick. I'm sure that number has gone up quite significantly right now as well.
Now, I want to just update everybody about the polls that we are currently running, because I don't think the attendees can see the results right now. But we will share the results of the poll a little bit later. Right now, the question that we've asked is, where are you parking your money now? And given 1, 2, 3, 4, 5, 6 different answers: savings, investing in stocks, unit trust, property, robo, and no spare cash. At the moment, leading the chart is savings at 36%. And then investing in stocks and unit trust comes second at 20%. No spare cash is at 16%. Nobody is investing in property right now amongst our attendees. 8% are investing in robo. So, we'll update the results a little bit later on. But okay, we want to talk about the people that are investing, right? So let me ask you this. Before there are robo advisors in the market, in the mix, at what age do people generally normally start investing, and how has that changed since the advent of robo advisors?
Yeah, I think I'll take this question. I think normally when you start working around 25, that's when you look at starting to save, right? I think when you first work and you get your first paycheck, let's be honest, no one is going to save or invest any of that, right? We'll go somewhere, we'll have a good time, and then you can do 1-2 years of this, but then after that, it's like, hey, I've been there, done that, I actually really need to build my savings. So I think before the advent of all these digital tools, the real options out there are ASB and ASN for most people. And then it'll be things like unit trusts, and it'll be things like stocks, right? So how you get into this really depends on the people around you, right? Who's there to advise you, what kind of information is out there for you to do your research. So I think these broad areas are really easy ways to actually start investing, but not all of them are good necessarily. So ASB, while it's all well and good, you can take loans on them as well. All of the investment is focused in Malaysia, and the return is actually slowly going down because obviously it's challenging to consistently make positive gains, right? It's all but guaranteed to make positive gains, so it's very hard to consistently make those positive gains. So that's just definitely one thing that you should look to invest, right? ASB is something that you should have at the core of your portfolio. The second option here, I think, where robo advisors are trying to disrupt, is really unit trust, right? Unit trust is basically outsourcing your funds to an expert for them to manage your money. I don't think that's a bad thing, but I just think it's very, very expensive. You have 3 to 5% upfront fee to just enter, and then 2% management fee. So all in 5 to 7% just to invest your money, right? And it's really, really high, right? So if you imagine just investing and then straight away you lose 7%, you need to make up that cost. It's very, very hard to do, right? And a lot of fund managers out there don't consistently make returns that is good beyond the FD rates. Then why are you really putting that amount of risk in unit trust, right? So that's where Robo wants to really compete. And then the third thing, like I said, is stocks, right? If you want to take your wealth management into your own hands, pick the right stocks and all that, there are a lot of very good brokers out there who have very low fees that you are able to go in and out at any time. But the issue there is really you have to pick a style of investing which works for you, and not just tikam and gamble because the bursa very quickly can become a casino if you're not careful.
Now, okay, I'm going to put on my my parents' hat for a while right now. Okay, I'm going to ask you sort of like an old person question. I'm sorry if you're not very young listening to this, but then it's a very valid question. Now, if I were to go with unit trust or stocks, I would have an agent or a broker. Robo, phone. If something goes wrong, if the market crashes, it will appear on my phone. There will be a down graph and I can't either. But I got nobody to call. How?
So I think that it really comes down to the service level. Not all robo advisors are the same. Like you said, if there's a crash in the market, you want to reach out to someone, right? And in March, we saw global markets got hit. In the US market, it was down 35%. In the local market, it was down 25%. And at that moment, someone to hold your hand is very, very important, right? So we are a robo advisor by nature, but we have a very strong customer service team. We actually have 20 people in our customer service team, humans, actual intelligence, not artificial intelligence. And you can reach them in a variety of ways. If you open the Stashaway app, there's actually a WhatsApp button that is secured, business account that you can chat with us straight away. Malaysians love WhatsApp. They send us memes, they send us emojis, like okay, that's cool. And then you can also call us on our hotline, and you will actually have someone pick up within 8 seconds for you to ask, hey, what's happening with my money? It went down 5% yesterday. Then we can give you some commentary and things like that. So while we are very, very digital, we also have a team on hand to answer any of your queries, right? It's all well and good to have a personalized agent, a personalized remiser, but then you ask yourself, is the cost really worth it, right? 5% just so you can call that guy once in a while is not going to cut it lah.
I mean, personally, if I kanchong, I know Ken, so I'll just text him directly, right? So that's an advantage I have. But jokes aside, because I've also invested in several of the robo advisors as well, and like Ken said, during this whole crash of the pandemic, I've observed the robo advisors doing a good job in communicating to the clients what's happening, what to expect, whether through the app or through email. So I don't really see it as an issue as long as the robo advisors are able to effectively communicate the situation to the customers.
Okay. Now, from an investor confidence point of view, right? It's great. It's great that you have a dedicated customer service team, and like what Vincent says, you've been proactive in communicating all the things that needs to be communicated, the messages that you would like to put out there for your investors. However, is this enough to win over a demographic that is dependent, especially in Malaysia? Because like what Ken said, we love to WhatsApp, but we also love to call the contact center. We love to do that, right?
I don't know. I mean,
we want to speak to a person at the end of the line. Now, does the fact that when you are dealing with robo advisors, you are dealing with somebody via WhatsApp and you're not able to call that person, so it's not a dedicated service per se. Is this enough to allay any inhibitions that one might have as an investor when considering where to park the money?
But I think it's a shifting demographic, right? While there are people who would personally prefer to take calls and ask these questions, there are people who hate calls as well. I mean, personally, I don't like to go through the press 1 for this, press 2 for that.
All right.
Yeah, I'd rather just send a WhatsApp, and then if his team can get back to me quickly, I would really prefer that form of communication. So you need to look at where the wealth is right now, right? So of course, majority of the wealth just around the world, you see it's lying in the baby boomers, but that's slowly shifting to the Generation X, and that's also slowly shifting to the millennials. So, eventually this would be the primary form of communication, right? So that's just the natural evolution of how products will be designed for the largest base, is my view.
Also, I think different people put different emphasis on different things when it comes to feeling in control and secure about their own money. So maybe if someone like our parents' generation would like dedicated, but other people like other things, right? So what we're seeing with our customers is that they like transparency. They like to know what exactly they are invested in, and then we give them a breakdown of their asset allocation. You know, this much is in stock, this much in bonds, gold, so on and so forth. Another thing that they really appreciate is the fact that, you know, while we are a robo-advisor, we are still licensed by the Securities Commission. That gives them the confidence to put their first investment in. And also the flow of monies is the same way as the normal funds management industry. So whatever you invest with us goes into what is called a trust account, which is an independent party in between us and the investment. So we can only use this money to invest. I can't use it to pay my rent, pay my gaji, and all that. So that trustee in place is very important. This is a key kind of criteria by the SC for us to have. And then the last thing, I think, while it is, it doesn't seem obvious, actually the user friendliness is very, very important. So how you intuit what to invest in, how do you read articles on the app, the colors and where the buttons are, all this science and art of user interface, it also helps you feel a certain way. If you look at all the e-commerce platforms, they make you feel rimas and anxious, right? Because they want you to buy something, they want you to do something on your phone. Buttons, you know, flashing cards and all that kind of stuff, free delivery, but they want you to jump in, right? So for us, you know, the way we've designed it is we have education and we have your money and you keep track of it, and that's it. Don't over communicate, don't scare people, right? Because we want you to invest for the long term.
Okay. Let's go into the demographics. Vincent has already mentioned this just now, as well as Ken. Millennials. So wealth is shifting from the boomers to the X to the Y. And it is the X and the Y that we'd like to know a little bit more of right now, because, you know, from what we can see, young people nowadays, they are not scared to take risk. They are willing to go out there, put themselves out there, you know, putting themselves out as entrepreneurs, e-commerce entrepreneurs. They are trying to find multiple ways to have money because it is an experiential economy. It's not about owning things anymore. It's about experiencing as many things as possible, right? So as wealth amongst the young grows, they are more open to the idea of investing in places like Robo. So where are millennials parking their money right now? And if they from what you can see, Ken, the bulk of millennials, are they risk averse or are they actually okay with risk?
Yeah, so I think it's, you know, these terms, right, like millennials and Gen Y and Z and all that are kind of marketing segments that people use to kind of target people and make kind of broad assumptions, right? What we're seeing is that actually there's no one size fits all. And even for an individual, it's not one size fits all the time. It really depends on your state of mind when you choose to invest that time. So that is why we really have 12 portfolios for you to choose from, because not everyone's aspirations and risk preference is the same. So what we tend to guide people is to look at their own self, not FOMO into what their friends are doing. Look at your own self, your own circumstances. Ask yourself, do you have a long time to invest? Do you have a short time to invest? Because that will determine how much risk you should take, right? What you're investing for, can you put that money to risk and all that kind of thing. So then we actually give you a portfolio that is tailored to you. But broadly speaking, what we're seeing is actually people in the 30 to 35 range are taking a very balanced approach, not all in on stocks, not all in on bonds. It's somewhere in between, around the 60-40 percentage, like 60% equities, 40% bonds. And that's a very good place to be, because the main thing about wealth is that you should hold it for the long term. And it's very hard to hold it for long term if it's too volatile, or even if it's too high return. Obviously low, if it's too low return, negative return, you won't even hold for a while. You leave straight away. If it's too high, right? Let's say like some stocks or cryptos that go up within a year, you know, you don't even feel like holding it anymore because you already make gains and you want to take it away. So what we try and do is to be very, very responsible with risk. Our returns are around 6 to 12% on average a year, and we try and retain that, you know. And what we're seeing is that customers actually, firstly, choose the 60-40 portfolio on average, and then secondly, they don't invest once. They invest in a recurring manner, right? Every month they put aside some money, right? So we see these deposits grow very quickly, and within 1 year, they actually double their investments in terms of how much they put aside. So gain more confidence, and they are taking the right amount of risk.
So it's recurring right now. So more and more people are preferring to recur. I mean, for example, the Robo Advisor that I use, that's exactly the mode that I've chosen. I've chosen to make a daily recurring investment of 10 ringgit a day. So it's, I couldn't even feel it. It's brilliant. And this is also one of the key USPs of Robo Advisors, at least from my point of view. It's the fact that the entry price is relatively low as compared to, say, the initial investment that you need to make on brokers, on stocks and all that. How is that panning out for the platform? The fact that your entry level is super low, and people taking it up, or are people actually coming in with a big chunk of money to begin with?
Yeah, so it also depends. So for younger customers, right, they are really trying out the platform by putting a few hundred or at least 1,000 just to try. If it goes well, then they tend to put more on a recurring basis, usually every month when they are gaji masuk. For older people, we see that if they already have money put aside, when they use Stashaway, it's for a very specific purpose, and they're not shy to come in. So for example, if you're slightly older, you would think that you already have your wealth secured. It's just that maybe you want to take more risk and you want to diversify in a different way. So because we invest your money globally, we are actually a very good way for higher net worth individuals to actually diversify their money outside Malaysia, get dollar exposure, get Asia equities exposure, things like that. So, I think different people use it a different way. Younger generation tend to do more recurring because it's more of a cash flow issue. If you're older, they cut us $1 million checks and they just go, yeah, just put this, just invest this, right? Because they have so much money on the side doing other things in safe and risky things, right? So the use case for us, for older people, is to actually diversify internationally.
Okay.
So just to add, to your point, you're saying that more and more Malaysians are taking up entrepreneurship. They're doing a variety of things. And that also gives rise to like the kind of gig economy that we're seeing, right? And with gig economy, you really don't have EPF for retirement planning. So then, things like robo-advisors become one of the baskets in which you can invest, right? And robo-advisors, while they are a great tool, they're not an end-all be-all. There's a variety of investments out there. And I think Securities Commission also recognizes this as well. If you look at what they've been doing for the past 4 to 5 years, they've really been trying to facilitate new types of investment products that's made possible through technology, right? So you have P2P financing, you have equity crowdfunding, you have digital asset exchanges, or better known as cryptocurrency exchanges.
Yep.
And, even robo-advisors as well. Personally, I'm also a big fan of equity crowdfunding because I pay a lot of attention to the startup space. And it's really nice to be able to get in early on some of these startup companies.
Yeah. The only difference is that, for all the other stuff, you actually have to be very hands-on.
Yes.
You have to know your stuff. So, in a way, robo-advisors work for the people who actually don't want to think that much about it. And I just want to park my money in.
It's a gateway, right? So once you start, start investing in something, then you can give more thought to, maybe I should start considering other forms of investment as well.
Of course. Yeah, so we've got questions coming in, but we will address those questions a little bit later. So I want to kumpul all the questions. So please, guys, get your questions coming in. We've got some interesting questions already that has been posted by our attendees. Also, I want to bring your attention again to the poll. So please, if you haven't participated in the poll, go and tell us where you're parking your money, send us your questions. Stay until the end of the session, because at the end of the session, we'll be sharing a link that our dear friend Ken has shared with us. And that will allow you to have, or rather enjoy, a 50% discount on the management fees on Stashaway. So, stay till the end of the session so that you get your goodies, thrown your way. Now, I want to understand a little bit about, the market itself and, where we are as a market. Is it a volatile market right now? What are the things you should be looking out for? Are the political situation that we're in right now, is that heavily affecting the way companies are performing, as well as the pandemic? Of course, that's what everybody's thinking about. So Vincent, paint a picture for us, please.
I think if you're talking about specific investment-related things, Ken may be in a better position to elaborate on that.
Yeah, absolutely. So thanks for the the question. So I think investing is a very risky thing, right? And while it is risky, there are many ways you can actually control the risk. It's not an all or nothing game. There are many asset classes out there that are risky and many out there that are conservative that you can blend together to have some sort of balance, right? So when you talk about the pandemic and when you talk about recession, it's very...
Let's just dumb this down a little bit.
Okay.
You mentioned many asset classes that have different risk profiles.
Yeah.
Which one you think are the ones that are, slightly riskier right now, and which one are the safer ones?
Sure. So when you look at different asset classes, right, you should always start with what is the thing that makes that has no risk. So these are things like FDs. FDs have no risk whatsoever. You get around a 2% return. And then something slightly more risky is something like bonds. So bonds, you can get a 3, 4, 5% return per annum. That you're taking more risk because, in case this company or this government goes down, they cannot pay you the bonds, then you don't get the return. But it's a little bit of risk and it's not likely to happen. So that's bonds. And then after that, it's gold. Gold gives you, gold's doing very well right now. So it actually gives you around 5 to 7%. Gold is something that you should always have in your portfolio, just a little bit, 10 to 15%, because it's a very good hedge on inflation and also it's a safe haven asset, meaning if things are very volatile, people don't know what is going to go, people will go into gold. That's gold. And then you got foreign stocks. Foreign stocks tend to be much more volatile than Malaysian stocks. So when I'm saying foreign stocks, I mean US market, Asia market, things like that. So Asia market has not been performing super well over the last 10 years. The returns are around 5-6% in Asia-wide. US market, also very volatile, but the gains are there to justify. So over the last 10 years, US market has done around 10-11% per annum. So, I mean, this is the range of the different asset classes.
Where does property come into this?
Say again?
Where does property come to this?
Property is in the middle, 5% on average in KL and Selangor properties over the last 10 years. So I think you need to understand, if you're taking some risk, what is the potential return that you should get back? If you're taking a lot of risk because it's very, very volatile, then you really should expect a much higher return.
Okay. And what Robo Advisors does is, depending on your risk profile, you will have a good concoction, a good mix of,
a good blend of these different asset classes for you to invest in. So coming back to your question earlier about, it's very volatile, what's happening in the market, I think with COVID, what we've seen is when COVID hit in March, markets all around the world really dive down, very, very quickly, because suddenly people don't know what's going to happen tomorrow. So they throw stocks, they throw bonds, everything, the markets fell very quickly. But then what the governments all around the world did very well, and our governments included, with this Penjana program and all this stimulus program for the different classes, they introduced life support for the economy and for consumers. So in the US, it was no different. They introduced a lot of life support. And because of that, markets really rebound very quickly. So in fact, if you look at the US market, in March, it was down very steep, in a very steep way, but then we've actually since recovered. So, even though the economy is doing badly, the markets are actually back to where they were before COVID. So that signals to me that you need to be actually very careful, because the markets are not showing what is happening in the real economy, because we only know what's happening in the economy in the rear view mirror. Markets are pricing in something, expectations for the future. So you need to be very careful, because it's not really kind of jiving or not really in sync right now, right? So you need to adjust your expectations and your risk a little bit. So what do we do with all this information, right? Like, there's so much negative headlines out there. Last week we had -17% GDP reported by Bank Negara, which sounds very scary, but let me put this into context. So these are all things that happened in the second quarter and the first quarter, right? This is the worst is over, and we are recovering. And at no point in time does it really matter, if you look at the long term, when you actually invest. If you invest at the bottom, at the peak, it doesn't really matter when you invest, as long as you invest in the long term. So if you're looking for the right place to start, is you should not look at starting with all your wealth in one thing today. you look at your options, you put a little bit here, you put a little bit there, and then over a long time, you just invest a little bit, right? So you can see long-term returns of stock markets all around the world is positive. When I say long-term, I mean 10, 15%, it's not like 1 day, 2 days, right? As long as you invest for long-term, you can actually take the risk of volatile markets off the table, because in the long term, stock markets tend to do very well, right? Of course, it's important to know what's happening in the economy and COVID and all that. But if you really have no time for this, because your life has to go on, then all you have to do is basically invest for a long time and in a diversified way. And that way you actually get rid of certain risks, right? You don't have to really worry about all those things.
So the platform itself is algorithm based, right? So the entire thing is done mathematically, and it's computed for you. Now the difference is, if you're working with a broker, they will be able to keep an eye on the things that are going up and the things that are going down. So if something is going down, they will quickly pull your funds out and then put it on the thing that's going up. How is that different from how it works in Robo? Do you still actually have to keep an eye on where the market is going? Because as you have created a risk profile for yourself, then you will understand, on the pie chart where your funds are being invested, right? So you actually have to participate actively and pull it out and put it back in and change the risk profile.
Yeah, you don't have to do that. All you have to do is choose what portfolio you want to invest in and then just let it run, right? I think the key message here is to at least keep it there for a few years, so that the fund can do what it's supposed to do. Down in the medium term, in the long term, it will still likely go up. So, don't be so gatal and try and itchy fingers and try and meddle too much, right? Because trying to go in and out of the market at the exact right time is basically introducing more risk, because you're trying to beat the market, and it's actually very difficult to beat the market. So it's best that you keep your money there, you monitor, we tell you exactly where your portfolio is at all times. And you commit to that platform and stay for a little while, right? Medium to long term. So because of that, you actually don't have to meddle so much and actually actively participate. You can just let it run. What I will say though, is that this, our offering is very different to stocks, picking stocks and all that, because with stocks, you need to monitor on a daily basis, because anything can affect these stocks, right? Because if you're picking not a basket, if you're not picking thousands of companies, you're picking like 1 to 5 different companies, anything can happen to these companies anytime. Bad news, good news, and that may affect how you choose to pull out the money or add more or accumulate or whatever, right? So with stocks, you need to monitor every day. And if you have the passion, if you like doing this kind of analysis, then that's fine. Have some of your money in stocks, right? But if you really don't have the time, you don't have the interest or the passion, then it's okay. Just let your money grow in other places.
Yeah, I mean, like when I use these robo advisors, like Ken's company and the other robo advisors, I generally don't look at the app like nothing more than once a month, to be honest. So sometimes I just look at the statements, because it's a long-term passive form of investment, right? And that's really, to me, the whole point of robo advisors is that it's kind of passive. And since then, from pre-pandemic to post-pandemic, of course there's a dip, but right now it's just back to normal levels, right? And I'm seeing reasonable returns on it.
I have a very tricky question to ask. If the name of the game is long-term investment, why do you make it so easy to withdraw at any time you want?
Because we want to give people control, right? Because while the name of the game is long-term investing, people need their money for different reasons.
Yeah.
Bocho, car, rosa, family needs money, friend need money, right? So we want to give them that control. And the thing about investing in, which is stocks and bonds, and they're all listed in the US, it's that it's very liquid and you can sell anytime. So while there is the need for long-term investing, you really need to have that self-discipline, right? We don't want to tell you, oh, you give me your money and say goodbye for it for 5 years. You miss your money, right? You rindu, you want to see it sometimes. So we are people, right? We are people, and we want to have control. We want to do certain things that sometimes are not best practice, and that's okay, right? Just have a budget for it, and sometimes if you need to correct some of your investments to do the things you want to do, live your life, right? We're not telling you to to be stingy, not be happy, right? So that optionality of taking out and spending your money the way you want to is how we choose to offer it to people.
I see. Now, let's talk a little bit about goal setting, because that is a commonality amongst all Robo platforms that I've gone on. You have to state your goal. But sometimes people just do not have a goal when it comes to investing, especially people who do not know how to invest, right? How do you set for something in the future that you possibly don't have an idea of what that future is going to look like yet? Because the importance of asking this question is because when you're setting the goal, it is also a huge factor in determining the risk factor that you want to have, right? So why and what are the best practices that one should think about?
Yeah, I think having the right attitude when you start investing is very important. We're all aspirational, we're all dreamers, but the way you choose to structure how you invest is very important. Because while we all want to be tycoons and retire yesterday and hit jackpot and all that, those are not things that are likely to happen. If they do happen, great. Then I'll call you Dino, I'll call you Vincent, and then we'll have a good makan somewhere, right? But until then that happens, you have to be very deliberate about the way you invest. So choosing your goal setting is very important because it frames your mindset about what this money is for and how long you should put this money away and what risk you ultimately take. So if you want to afford a down payment on a house, which is maybe 5 years away, you would invest that money very differently if you said you wanted to retire in 20 years. If you want to invest in something short term for a financial goal that is in 2 to 5 years, then you should actually invest in something rather conservative because you don't want to necessarily lose your principal. But if you're investing for over 20 years, you don't want to retire and be disappointed with the amount that you've put aside for so long, right? So you want it to be more exciting. You want to take more risks. And you can afford to take more risks because you have a long period of time. In case the markets do drop, you can recover because you still have time. So that's very important. And I think people should really come back to themselves and ask themselves why they are investing and then prioritize and quantify some of these goals because they can actually help you be a better investor.
Okay. All right. So we've got about 9 minutes left on the session. So I want to go into some of the questions that we have received. So I believe my colleague Amy is already ready with some of the questions, right? Okay. We want to go into this question from Lutfil Hadi. I have two questions. Did Robo advisors ever consider diversifying their assets to invest in cryptocurrency such as Bitcoin? If not, why? And then the second question is, what are the average annual returns for previous years for Stashaway particularly?
Thanks, Phil. So question number one about crypto and Bitcoin is that while it's an exciting asset class, it's not an asset class that we think should be part of your main portfolio, right? So our main portfolio is made of very established asset classes that we know the behavior and have a very long-term track record. So while it has been around for a while, it hasn't been around for 20, 30 years that you can see it performs through different economic cycles, right? Like recession and good times and all that. So Bitcoin is a little bit too speculative for us, which is why we choose to exclude it. My 2 cents advice about Bitcoin and crypto is that one day it might be worth something. It might have a very popular use case. So have around maybe 1% of your total wealth into Bitcoin, because if it goes to the moon, so to speak, that means you have some money that did grow, right? Not have 90% there because that's very risky and it's very volatile, and you don't want your wealth to go up and down the volatility of Bitcoin. The second question is about return. So that's a very important question. So while we don't guarantee returns, so to speak, we can tell you what we've achieved over the last 2 years. So last 2 years, we have 12 portfolios, and the lowest risk one has done 11%, the highest risk one has done 23%. That's if you invested from the start, right? Mm-hmm. This is something that is very individual. If you invest today, the returns will be very different from if you invest 2 weeks ago or whatever. But what you can actually smoothen out the returns is, like I said, long term, right? 6 months, 1 year, that will actually kind of normalize the returns. So last 2 years, we've done 11 to 23%.
Which is comparable to actually just investing in foreign stocks, full stop, but with a lot more ease. Vincent, I want to go to you and ask you about Bitcoin because I saw that you had a little bit of a reaction when Ken was talking about it.
No, I mean, when you think about it, cryptocurrency doesn't really fit into passive investing, right? The cryptocurrency has to be a very active form of investing where you really have to monitor the thing, right?
Yeah.
I've seen some projects who, like, in one day they go up by 90%, and then the following day it's like back to 0%. Like, it's virtually zero value, right? I'm not saying that's necessarily a bad thing, but it requires very hands-on understanding on the projects, the technicalities, the vision, the team.
Which is the exact opposite of what Robo offers.
Yeah. So then, it's two different types of investors, right? And I don't necessarily see that it's a good thing for robo advisors to go into cryptocurrency because it's for different types of investors.
Okay. The next question is coming from Leah. As someone who is new to investing, what do I need to know if I'm signing up for my first robo advisor? There are multiple choices for you to choose from. Stashaway is one of them. So we're very happy to have Ken with us. But we've also got stuff like Raise, and if you're particular about Sharia compliancy, then you have Wahid Invest, for example, right? But when you are shopping around, what should you be looking out for?
I'm very, very happy that the viewers are asking this question, because there are a lot of times when I ask people why did they choose to invest in certain things, and it's like, oh, it's because of my aunt's brother's friend, they're selling this thing, I want to support, right? Your goal in life is to meet your financial goals, not to support all these people, right? Like, want to support by selling cookies and all that one different, right? You can eat or whatever. Financial products is completely different. So I think Leah's question is very relevant, because everything you invest in, no matter whether it's robo or not, you should ask, how is it different? What are the things to look out for when investing in the first place? So when it comes down to robo advisors, I think there are a few things, right? So the first thing really is, what are the fees? Fees are very important, because every percent you pay in fees is percent that comes out of your return. So if your gross return is 5%, then your fees of 1%, then your return is 4%, right? But if the fees are very high, say 2%, then you only get 3% net return. So fees is the first thing. The second thing is, what does it actually invest in, right? What are the actual asset classes that they invest in? What kind of bonds, what kind of stocks, what percentage in gold, what kind of REITs do they expose you to? So that's the second thing. And then the third thing is performance, right? I think because robo-advisors are quite new, there's only so much data that they can share. We only started sharing data after about a year, because in the first few months, it's a bit too early. So I think now that we have returns, and then we've done 11 to 23% over the last 2 years, then we can actually show you some returns, and you should compare those returns. You can also compare these returns in difficult times like March, right? When March happened, the markets were very, very volatile on the downside. You should see how much did the Stashaway portfolio fall down, right? And is that more than the risk budget that I'm willing to take, right? So performance is something. And then the fourth bucket, which I think is also important but very personalized, is really the experience, right? Do I like the interface? Do I like the ease of investment? Do I like the education, right? Like, all of this is very personal. So everyone will find a fit in the different robots that there are out there that suits their lifestyle the best. Whatever decision you make, don't procrastinate, right? Because you have to start investing for your future.
Can one person invest on
You can just
platform?
add to that, right? And I think there's one more very important thing to consider before you decide with your robo-advisor, is to ensure that it's regulated by the Securities Commission. Right. Because there are some players out there who are regulated in other regimes. They claim to be able to offer services over here, which they are technically not really allowed to, and you won't be accorded to protections from local laws. So for now, as far as I'm concerned, the only few players that are approved by SC is Stashaway, MyTeo, Wahid Invest, Rise Invest, and there's several more approval in principle, but generally you want to be able to check whether or not they're licensed with the SC.
So you have to do your homework also.
Yeah.
What I was asking was, is it okay for a person to actually, in the interest of diversifying, not only just diversifying your portfolio, but diversifying the robo platforms that you're on?
Yeah, it's up to you, right? Like, I think in life, no one thing should be the silver bullet, right? in one person's life, I think there's probably 3 to 5 platforms that you can use in a meaningful way, meaning you put most of your money there, that will serve most of your needs, right? So, you know, you have one Robo platform, you have one stock portfolio, you have your ASB and other kind of investments, right? So while it's all well and good to experiment with many different platforms, at one point you need to Marie Kondo your own financial holdings, right? You can't have so many usernames and passwords to remember and how much money you put here and there. If you start with small amounts, that's fine. But ultimately, I think you should narrow it down.
We have a question from Megat Sharizal, who was asking, can I use EPF to invest? Simple question, but valid.
Yeah. Right now, not yet, because the EPF has this criteria for what's called Managed Investment Scheme, MIS. So for Robos right now, the guidelines are still being revised. So we will look to maybe next year to start looking for your EPF money to be invested via Robo.
Right. So for now, if you want to invest in EPF, the only means for you to do so is still through unit trust, I think.
Yeah, but the platform you should use is EPF's iInvest, a digital platform that is set up by EPF themselves to actually allow you to invest in the various unit trust companies out there. Unit trust companies, you know, you have to look at their performance, but there are some good funds out there and are already qualified for EPF. The good thing about iInvest is that the sales charge is 0 or really, really low, like under 1%. If you go through an agent for your EPF, it's 3%. So I just saved you 3%, you know. So
right.
Use iInvest and choose the fund that suits you. And you should do it in a very deliberate way, because you don't just want to say, oh, I want to invest for fun. You know, you should take out your EPF to diversify, to get higher returns. And the benchmark to beat here is, can this perform beat 6% after fees? And that's not easy to do.
Which is the EPF return, right? Yeah. It might not sound a lot, but then, you know, if you think about it, let's say you're investing 100,000 from your EPF and it's 3% that goes to the agent fees. That's
1,000. Yeah, that's a lot. That's a lot. And if you invest every time, right? Say you invest 100,000 maybe once every 2 years, that's 3K out of your pocket every time.
Leah has got another question, which is, how often does the algorithm update itself? Risk factors change depending on global national happenings. Can the system adapt to this change so that I'm not being assigned assets that are crashing?
Right. So yeah, that's another factor you should really take into consideration when investing using a robo advisor, because how we manage your money is very important, right? And you can either agree or disagree with our approach. So how our system works is that we look at economic data. Economic data will tell us where we are in the economic cycle, in a good time, in a recession and all that. And we will change our asset allocation, meaning the mix of the assets, depending on where we are in an economic environment. So for example, right now we are in a recession. It doesn't mean you don't invest at all. You keep your money in the pillow. There are still asset classes out there that can give you a good return. So in a recession, you want more protective assets like bonds and gold and equities that are in safe sectors, you know, like consumer staples. So we actually changed our asset class based on economic data. And since the 3 years that we've been up and running, since our company started 3 years ago, we've only changed the asset allocation 3 times. So we change it in what we call a strategic way, meaning it's a big picture, long-term way. We don't change it like, oh, today this is hot, oh, that is hot. And this is we're not schizophrenic, right? We look long-term, you know, medium-term, and we see where are we in the economy, what's the right portfolio right now. So that's how we do it. There's a lot more information on our website for that. For that question as well, what you don't want is a portfolio that remains static all throughout the different economic cycles, boom and bust. Good times looks like this, bad times looks like this. Your portfolio is not your husband, it's not your wife. You can change your portfolio from time to time, right? You don't need to remain the same, right? So yeah, that's one thing about our portfolio, is that it's relatively dynamic.
Okay, got it. All right. I think we've probably covered most of the points. Any closing remarks from you, Vincent? Perhaps what is your key point to consider for people who are actually looking at investing today, right now?
I mean, do your research, do your homework, and get started. I mean, it's really important to invest your money.
Okay. And Ken, this is where you tell us about this offer that you are sharing with us. I'm going to get Amy to put the offer up right now. So attendees, do check out the offer tab that we've actually put up. Tell us about it, Ken.
Yeah, I want to say a couple of things. So firstly is this offer, like I mentioned earlier, you get 50% off for 6 months, which means that normally we charge 0.8% per annum. So if you invest 1,000, the fees is only 8 ringgit, which is less than your coffee, your single sauce, fancy cappuccino that you get, right? So that's very, very low fees, but we're going to make it even lower. So for 6 months, it's only 0.4%, and there's no minimum investment. So you can invest a few hundred, a few thousand, whatever it is you're comfortable with. So that's the first thing. The second thing is to also check out what we call Stashaway Simple. So Stashaway Simple is a very different product to what we normally promote. Stashaway Simple is like FD, but better. It is something that you can invest in for a very modest return, 2.4% per annum. And you can actually withdraw your money anytime. You don't need to lock up your money like FDs. So this Stashaway Simple is 2.4%, like I mentioned. You got no terms and conditions, so you can invest whatever you want to invest. And it's really for the part of your portfolio, which is you don't want to take a lot of risks. So for your emergency savings, for your money that you want to spend in a few months, you can just park it in Stashaway Simple. So enjoy.
Fab. Thank you so much, gents. So don't forget, keep yourself updated with the latest economic news, because you want to be on top of where the market is. So you can always tune into AstroAwani.com for the latest news, especially business news. We will actually be putting up the link for you to download our app. But also, Vincent is with FinTech News Malaysia. So that's a great resource for you to go and check out the market, see what are the performing sectors, and you don't want to miss out on those opportunities. I think that's the key takeaway over here. Go ahead, invest. There's no better time to invest rather than the now. So do that, especially with Robo Advisors. It's super easy and it's super cheap to go and start investing. So that's great. Vincent and Ken, thank you so much for your time.
Thank you for having me.
That you will be with us again soon. So do reach out to us if you have anything. Before we go, 2 last things. I just want to update everyone about the poll. So the last standing is this, what you're seeing on your screen right now. 41% savings, 19% stocks, 19% unit trust, 6% Robo, and 12% no spare cash.
I think the 12% might need to find new jobs.
Quite true. Or they might want to start investing to see if there will be spare cash that that emerges from their investing activities. So that's the thing. And the last thing that I want to highlight to you guys is our next webinar that is going to be happening tomorrow. Everybody in the world is talking about mental health right now. And we want you to know how you should be assessing yourself. You need to be asking yourself, what is my mental health? So the topic that we'll be talking about tomorrow is Murong ke Mental, Apa Status Anda, which will be conducted by my good colleague Malina Manaf. And we want to help you understand your current state of mental health and what are the things you could be doing to either help yourself or your loved ones. So it's important for us to have a clear picture of what it takes to be in the pink of health mentally. All right. So again, Vincent, thank you so much for your time. You've been with me, Dino Omar, and you have been here on a workshop by LINC at Astro AWANI, and we hope to see you guys soon. Bye-bye. Take care.